To cut or not to cut? Wall Street is betting that a September Fed rate cut is a done deal, and that moreover it will help push up the stock market and push down the US dollar. But what could spoil the party? And what should you be doing with your money right now? September is not a good month for the stock market. Since 1945, S&P 500 has declined about 0.7% on average in September, making it the weakest month of the year. How has the so-called September effect held out in more recent years? Over the past 20 years, June was the worst month for stocks. However, September, alongside January, was the next worst month for stocks. In theory, seasonal anomaly like the September effect should disappear over time. This is because if everyone expects September to be weak, they would all be selling in August to buy back in late September, which would erase the anomaly. The fact that the September effect has persisted despite being widely known suggests that either market efficiency is overrated or that the forces behind the September effect are so powerful that they cannot be arbitraged away easily. Window dressing by mutual funds ahead of their September fiscal year end is thought to be one of these forces. But this does not gel with the fact that actively managed mutual funds are a shrinking share of the stock market. A more plausible driver of the September effect is liquidity, as it so happens that September is not a good month for the bond market either. Over the past 20 years, September has been the fourth worst month for the performance of US Treasuries, just behind October, December, and February. More importantly, out of these months, September and December are the only months in which both stocks and bonds do poorly. This further strengthens the liquidity hypothesis, as it is unlikely a coincidence that September and December are usually the busiest months for the issuance of US government notes and bonds. Furthermore, September is also one of the two busiest months in the corporate issuance calendar, as issuers return from summer lull and try to lock in funding before year end. In my view, the September effect is largely the result of a seasonal increase in bond issuance that pushes up bond yields, which in turn push down stocks. An increase in issuance that cheapens US assets also makes them more attractive to foreign investors. This could be why the US dollar tends to do quite well in September. What all this means is that if this September turns out to be another typical September, stocks and bonds will struggle while the dollar will do well. S&P 500 is now up 4 months in a row. If past Septembers are any guide, the bond market will have a big say in whether it can make it 5. Indeed, it is a bad omen for stocks that long-dated bonds are trading as poorly as they can be. Over the past month, 30-year government bond yields have gone up by 36 basis points in France, 27 basis points in the UK, 19 basis points in Japan, and 10 basis points in the US. Concerns about fiscal sustainability are not new, but lately they have been compounded by an increase in political risks in several major economies. In France, the government of François Bayrou is almost certain to lose a confidence vote scheduled for September 8th. Whether this would force Macron to call another election in little less than a year or not, the bond market is reminded once again that France has zero appetite to tackle its mounting government debt now sitting at 114% of GDP. Indeed, with the far right and the far left controlling more than half of the seats in the National Assembly, and set to gain even more seats in the next election whenever it's going to be, France has already passed the point of no return, fiscally speaking. Milton Friedman famously said, "Only a crisis, actual or perceived, produces real change." I believe the only hope for France is a major economic crisis, a crisis so severe that fiscal austerity will feel like a walk in the park. I suspect this is the calculation behind Bayrou's decision to call a confidence vote. But what about Macron? Macron drew wide criticism last year for dissolving the National Assembly and calling for early elections. Would he decide to do it again? But this time to let French voters find out for themselves whether a far-right government can deliver what Marine Le Pen promises. The way I see it is that the biggest risk to the French and the European bond market right now is if Macron decides that it is not only futile, but counterproductive to postpone a real crisis any further. If Macron is an idealist, Keir Starmer is an opportunist. I can't remember another British government that shows so little tolerance for political pains. It is truly remarkable, especially considering the huge number of seats won by Labour in last year's elections, that should have insulated it from political pressure. The speed with which Starmer backtracked on his welfare reform and the abolition of non-dom status was less governing than flinching. With Starmer doing the bare minimum he thinks he can get away with, the bond market is left with no choice but to take matters into his own hand. Rising gilt yields will make it even more difficult for Starmer to stabilize the fiscal hole. Credibility is a fragile thing. It is difficult to get it back once it is lost. The UK is in a vicious fiscal cycle. A vicious cycle made worse by stubborn inflation. The only hope for the British bond market is if Starmer were to wake up one morning thinking he is a Clement Attlee or Margaret Thatcher. My bet is that for that to happen, things will have to get even worse. Earlier this week, the Japanese ruling party Secretary General Hiroshi Moriyama, a close aide to Prime Minister Shigeru Ishiba, said he intends to resign from his post. Since LDP's defeat in the upper house election in July, the calls have been growing for Ishiba to step down. Ishiba has waited for a long time to become prime minister, and he is not going to go down easily. However, the bond market views Moriyama's intention to resign as an indication that pressure is becoming unbearable. What do LDP prime ministers do when they try to quell party rebellion? They spend more money. Japanese media reported this week that Ishiba plans to ask ministers as early as this week to compile an economic stimulus package to address inflation. The bond market is worried that the price of political continuity will be an even bigger deficit. A weak yen and rising inflation over the past few years have driven up tax revenue and driven down real interest rates. This has done a lot of good for Japan's fiscal sustainability. The bond market will be very unhappy if politically expedient cash handouts and tax cuts reverse this process, especially given long-term bond yields remain in deeply negative territories. Increased political risks have been driving up long-term bond yields in Europe and in Japan. This and Trump's attack on the Fed have pushed up long-term US bond yields too. If the US stock market has not reacted more, it's because investors are pinning their hopes on the Fed to come to the rescue. The market is pricing nearly a 100% chance of a September rate cut. In an earlier video, I argued that aggressive inventory drawdown is why we have seen very little pass-through of tariff into inflation and a surprising improvement in corporate profit margin in Q2. However, as the holiday shopping season approaches, I think companies have no choice but to restock, and with it, we will see inflation picking up. We will get the August CPI and PPI release just before the September FOMC meeting. I think these numbers will vindicate my view that inventory rebuilding has started, and that inflation will be hitting higher from here. Once inflation starts to move up in earnest, I think even Trump will stop his Fed bashing. The Fed made a mistake 3 years ago, assuming that inflation was transitory. The tariff-induced inflation to come may or may not be transitory, but I think the Fed will be much more careful this time. The bottom line, at least for the next 4 weeks, my central scenario remains for higher rates, lower equities, and higher US dollar. Thank you for listening.